Chit Chat Money. Today is Tuesday, October 13th. Today we have an interview with Will Hershey, CEO and co-founder of Roundhill Investments.
Big time interview.
Yeah, it was a lot of fun. It's really interesting what they do. It's, he'll dive into it, but it's the ETFs. They've got two ETFs. It's the Bets and the Nerd ETF.
And don't forget Deep Value.
And Deep Value.
Yep.
And those are, the Bets and the Nerd are gaming and gambling. Right?
Yeah, so they're not factor focused, they're thematic focused. They're kind of a startup going off of that, and they've had a lot of momentum, and it's exciting to hear what they're doing.
Yeah, and then we have our own stories before that. What are you talking about?
Mine? It's kind of tough to say what it is. It's a paper from Morgan Stanley talking about how to actually classify free cash flow and intangible investments. So going to be a real fun topic,
yeah,
right?
Really exciting.
Mm-hmm.
And then I've got the Twilio acquisition of Segment, so that should be a lot of fun. And then we have our current state of FinTwit. We have Hot Water, Fuck, Marry, Kill, and Anecdotal Evidence. Let's go.
Welcome to Chit Chat Money. On this show, hosts Ryan Henderson and Brett Schafer interview industry experts and riff on the world of investing. As a quick reminder, Chit Chat Money is a CCM Media Group podcast. Ryan and Brett are not financial advisors. Anything discussed on Chit Chat Money by Ryan or Brett or any other podcast guest is not formal advice or a recommendation. Now please enjoy this episode.
Welcome in. Should I kick things off or you?
You go ahead, yeah.
Okay.
Take that out of the way.
This morning, Monday morning, so we're recording on Monday. It's coming out on Tuesday. Twilio officially announced that they are acquiring Segment for $3.2 billion in an all-stock deal. Quick breakdown of both businesses if you don't know either one. Twilio owns a library of APIs that developers pay to use when building out communications tools on their apps or websites. And if some of that was mumbo jumbo, I'll explain it. And then Segment also runs a similar model, except the APIs are built to help better collect and use customer data. And so they're pulling together data from a lot of different apps as well. So think about if you're building a website to sell purses or something like that, and you want to have instant messaging function on there, and you wanted to see how your users spend their time on your website, how you could better market towards them. You'd be using a Twilio API, you'd be using a Segment API, and all that stuff. It'd all be embedded in there.
Right.
But as far as the actual deal goes, Segment's latest private round was at a valuation of $1.5 billion. That was in 2019, April of 2019. And they obviously got bought out for $3.2 billion in an all-stock deal. The deal was financed in Twilio Class A common stock on a cash-free and debt-free basis. Basically what that means is that when a buyer purchases a company and its assets, it is on the basis that the seller will pay off all the debt and extract all excess cash prior to completion of the transaction.
Did you find that on Investopedia?
Oh, yeah, big time.
Yeah,
I did not know what it was, so I was like, I'm going to look that up.
Classic Investopedia right there.
Okay, but without knowing any of the financials of Segment, do you think Twilio overpaid, or does this look good?
On an absolute basis, perhaps, but it seems like the acquisition makes sense. And then when you look at the fact that Twilio has a premium stock price, a lot of people are celebrating management, which I think I agree with, for using that expensive stock price as a currency to acquire other companies. Now, the catch there is, like, if you're an investor of Twilio, are you just admitting that the stock's overvalued? Maybe, but it kind of shows that management is willing to think, all right, we're going to have to dilute shareholders here, but it's the right thing to do because our shares trade at such a wild valuation.
Right, and as of this morning, Twilio, I believe, is about a $50 billion business. I didn't know that.
Market cap-wise, yeah. I mean, it's had a fantastic run.
Do you think Twilio will be like the backbone of most websites and apps going forward?
It's tough to say.
They're building out a lot of functionality in the API space.
Yeah, I mean, it seems like they're trying to own everything in that. So it's
that's
really hard to know.
Going to be a huge market.
It's out of any expertise I have. I don't have it in APIs, so it's tough for me to say. But all I can say is they have a lot of momentum.
Here's the thing, and this always either makes me think the market is wildly overvalued, or we tend to misprice a lot of software companies, because Like a year ago, we were like, oh, we've missed the boat on this thing. And now we look at it and we're like, oh, we missed the boat. Is this one of those where I say that over and over and then it 10x's?
It could be. And the thing is with investing is if you lose, on this one, we chose not to invest and it didn't work out because we chose not to and it turned out to be a market beater. It doesn't mean you can't beat the market investing in other things. You don't have to swing at every pitch. And if you don't understand Twilio, you might not want to invest in it. But if you do understand it and you think, all right, Twilio is going to dominate this market, I actually know how all these software APIs work, you got a clear advantage, at least from my purview.
I mean, you don't really get a firsthand experience of the customer value prop unless you're a developer.
Right. Or you're just really smart at learning these companies.
I tend to like companies where I can at least get my hands on the product and understand it. It's pretty hard to do if you aren't building out a website.
Agreed.
Okay, that's all I had. So
all right, mine, it's going to be a little more of the eat your veggies, as they say. So it's from Michael Mobison and Morgan Stanley. It was a paper published mid-September, so it's about a month old, and I didn't really see it until recently, but lucky I did because this might be one of the best papers I've ever read. Most papers you read are like, gosh, this is just boring, dry stuff. There were so many nuggets in here. I'm probably only going to hit like a third of them. But it was on intangible investments and free cash flow and how to classify things correctly. So he starts out, I guess, with an anecdote on Walmart. If we go to the top here of the paper, it's only like 25 pages, so not even that beefy. And like a third of that is graphs and the index or whatever, the annotation. So not even that long. He talks about in the intro here, though, that there's a company that's profitable for the next 15 years. It's going to have steady profits. It's going to grow those profits at a 40% compound annual rate. And it's going to initiate a dividend, which will grow at a 50% compound annual rate. But the same company is going to have negative free cash flow for the next 15 years. The level of debt will grow at a 34% compound annual rate over that same time frame. Would you want to invest in that company?
I'm having a little bit of a hard time following you verbally.
Okay, sorry, that's a lot of numbers, but say terrible cash flow, good earnings.
No.
Well, that company is Walmart, one of the best performing stocks of all time.
Wait, so they terrible cash flow, but good on a GAAP basis?
Think of it like Netflix right now. So they're technically earning money, but on the cash flow basis, they're investing more into the business. So the capital expenditures are a lot larger. But they're getting a high return on invested capital, which I think for Walmart was 18%. So it's just showing that on a GAAP basis, even if you have a ton of negative free cash flow, it doesn't mean it's going to be a bad business. And it also shows that GAAP accounting can make things seem like a company's really profitable or not. And there's just a ton of nuance there. So he has that anecdote.
It's a classic Amazon thing, right? Where no one really knows how profitable they are because they're pouring so much into CapEx.
Yeah, and the classic example of when is someone says, well, Amazon's never made money. And it's like, well, technically they haven't stated any earnings, but they have had a lot of operating cash flow and cash flow. But that's just an example he wanted to use on how things can get distorted and each business is unique. But it does go into different things here. So the overview of the entire paper was how should investors classify research and development and SG&A expenses, like to properly account for these. Are they intangible investments, i.e. should they be expensed in the income statement or should they be put in with capital expenditures as a financing operation? And he kind of thinks that a lot of stuff that is being put in the income statement, which is decreasing operating income, should actually be put in capital expenditures, and instead of so operating income would rise in that case, correct?
Like what was he highlighting that is often in the
I'll get into it, but one of them he says, first off, every company you should add back stock-based compensation. Yeah. Right? So stock-based compensation is a way that these capital-light businesses kind of cheat, but not on purpose. It's just the GAAP accounting. Okay. They kind of cheat and make their free cash flow higher than they think. So he says you should take the free cash flow number you get from a GAAP basis and subtract out any stock-based compensation.
Right. And it feels like they're kind of cheating it, but Bill Brewster had a good point on Value After Hours this week and was like, if you were in management shoes, why don't you do the same thing?
Oh, he's not saying it's a bad thing, but he's just saying that you should add back because it's not expenses. It's the way you finance your, and I'm going to say property and equipment, but the property and equipment for these capital-light software companies are the brains of the developers that are building these things.
Right.
And that should be amortized as an investment, but not an expense. So it just makes that cash flow number seem higher than it actually is. Do you agree with that? Does that make sense?
Yeah, it feels like a lot of it is like you just have to look at the expense on sort of a absolute basis.
Yeah.
Because a lot of it you can kind of add back here and there, and there's like gray area. Like, especially with the software businesses, there's so much, there's so many expenses that are in between, like where that would actually go.
And one note he made is that if a company has high gross margins, it's an indicator that they're hiding a lot of their investments on the operating expenses line. So a lot of the companies we look at,
oftentimes
software as a service, 70 to 90% gross margins, they can be hiding a lot of things in the expense line that is actually capital investment. So
okay, yeah, I've had a gripe with this before.
Yeah, the paper goes into a lot more detail, and it's really hard to discuss it like verbally. So I'm gonna make it kind of dumbed down, but yeah, that's kind of the way he put it.
There are operating expenses that scale with the business. People tend to forget that. I mean, I've maybe done it before too. You see like 91% gross margins, and you just think the margin conversion over time, once they hit scale, operating will be really close to gross. There's a lot of times when there's nuance to that, and that's not true.
Yeah, and I mean, he sums it up like this. So here's a quote directly from the essay. The recording of investments has largely migrated from the balance sheet to the income statement. An investor's job has not changed, but the analytical approach has. So if you want to cheat yourself, you can just use the standard GAAP stuff and just calculate the cash flow and calculate it using a simple formula. But in reality, you probably need to do it on a case-by-case basis. One note he had here is that in 1974, the Financial Accounting Standards Board, whoever classifies everything, they decided that R&D expense should be expensed, as I just said, and not capitalized, which means that it's put in the operating expense line, but it's not put in the investment line. So Mobison says in the paper that he argued that for these capital light businesses, the R&D is the intangible investment, and that most of the time, 100% of it should be taken out of the expense line, which boosts operating income, right? Yeah. But it should be amortized, or a lot of it will be taken out of the expense line. It should be amortized over the life of the contract, 5 years, 10 years, and then added back into the cash flow statement.
It's really hard. It's really hard to do this not visually, looking at it. So I'm sorry to the listeners if we're kind of rambling, but
I think, does that make sense though?
Yeah, I mean, yeah, and I saw this on Twitter, so I do agree. I think you tweeted this tidbit out, right?
Yeah, that one especially. Yeah, and then what about advertising expense? People estimate that should be about 50% of advertising expense, depending on the company, should be capitalized, and therefore instead of expensed directly amortized over the life of the contract. Yeah. I could argue that that's basically an investment. But the thing is, you got to do it as a case-by-case basis.
But if you're a software company, sometimes that's literally that's a cost. That is an operating cost. That's how you do business is by marketing to get revenue. Mm-hmm. I don't know. Like I said, there's nuance to everyone.
And he was saying in the paper, there's not a perfect way to do everything. I mean, you have to make a ton of assumptions, and I think the best way is that you have to look at every company on a case-by-case basis and start at gross profit and say, okay, what assumptions do I make here? What things make sense? Because some companies like Walmart are different, but if you're looking at Microsoft, it's going to be entirely different how you look at the cash flow statement.
Yeah, and FYI, if you're wondering what all is included in those operating expenses, they usually, on the 10K, they break down every line on the operating expenses.
Yeah,
so
they do.
That's a good place to start if you don't know where to go.
Yeah.
Okay, is that it for you?
Yeah, and like I said, only covered about 20% of that. So I'd recommend reading the paper to get the full thing because we're kind of top level here.
Okay, that leads well into my current state of FinTwit.
Go ahead then.
First of all, isn't financial Twitter just boring when it's all-time highs?
Yeah.
And
rocket ships.
We're on the West Coast, and so every morning I just wake up to everyone with tickers and rocket ships.
Eyeballs.
And it's That's not what I want to see in the morning. I don't know. It's
yeah.
it's very much the same every week when it's all-time highs, and I'm happy everyone's making money, but, maybe a little more analysis would be good.
Yeah, I agree.
But anyway, I posted a poll this week on Twitter and asked whether $1 in profits from a software business was worth more or less than $1 in profits from a manufacturing business, which it's what I was aiming for was the whole what weighs more, a pound of bricks or a pound of feathers, and
Classic, trying to trick,
right.
Little trick for the brain.
And I think people were either misunderstanding what I was asking or a little delusional about it.
Well, they were instinctually going for that software, like instinctually.
Right. They were going for the earnings quality or the future value of each dollar they earn. Because let's say it gets down to the bottom line for a software business, technically, that's worth more when they reinvest it.
And we just learned that it might not even be. We just learned it might not even be real profit, right?
Yeah, and here's my thing. But those dollars are needed to pay for things that isn't always different. So let's say you have debt that you have to pay off. You don't get to pay less as a software business. Office space, salaries. Yeah. I mean, I guess you can use stock-based compensation, which a lot of them do, but
and it depends what your valuation is, or else it's might not be as worth it.
Yeah, it just. I don't know. When it comes down to the balance sheet, the dollars are worth the same.
Also, software companies don't always have high reinvestment. Some software companies are bad.
Yes, that is. Yeah. Anyway, it just made me think there is a lot of froth around software.
Yes, I think you are not taking a bold stance there.
No, I guess that's true.
It's not. It seems contrarian to say, all right, we just want a solid business, no matter what type it is, but. There's some people that will, I feel like, only invest in software, and that's just limiting them. And they're just seeing software, they're putting it on a pedestal, especially software as a service.
That's the other thing. Okay, not every software business is higher margin than a manufacturing business. Okay,
we were just researching Altria.
Altria, 65-something% gross margins, EBITDA margins 55%. Yep. Name one software business other than maybe MasterCard that hits those EBITDA margins.
Yeah.
I guess there are probably.
But, whatever. I mean, people could argue reinvestment rates, but yeah.
Okay. All right. What did you have?
Okay, I got 3 here. Let's see. First one from Pythia Capital. Great follow if you haven't seen this. All right. He tweeted basically about Disney Plus. He said, if you think Disney Plus is a good business and a key part of Disney's flywheel, quote unquote, even though everyone overuses flywheel, right? Yeah. It allows them to earn superior ROIC than Netflix. Why wouldn't you support a massive additional reinvestment against that amount? Right? Does that make sense?
Yeah.
And we just got an announcement that they are doing that after that activist came in, but there was a ton of people arguing that they shouldn't do that. What do you think?
Wait, they were arguing for the dividend? Like a lot of people were asking to not reinvest it?
Not specifically for the dividend, but more of like balancing the investment across, traditional movies, cable, and Disney Plus. But a lot of people are saying, no. It's time to go all in with Disney Plus and the streaming services, and that's what that activist Dan Loeb was saying too.
That is true, because I know a lot of Disney. I guess I do. Very different businesses. I know a lot of Disney shareholders that are like, well, Disney Plus is going, that's going to be a huge catalyst, huge growth driver for them. But then they're like, but they also have the parks and all that stuff. So, having that balanced approach. And I'm like, why wouldn't you want it's the software thing again. If it's worth more, reinvest it in there. Why not have that money there?
But then if there's too much money chasing off of, so there's going to be so much.
Don't get me wrong.
The supply of streaming is going to be so high.
I don't buy the Disney Plus hype. I wish a lot more money. I mean, obviously it's hard times for the parks right now.
Yeah.
But I don't know. I mean,
well,
it is a bigger business than streaming.
Yeah, this may feel a little anecdotal, but don't you feel like the supply of streaming content is just getting so saturated, like way overly saturated, where the returns on it are going to decrease substantially for all these businesses?
I'm not complaining as a consumer.
No, right?
But, yeah, as an
the
investor,
demand's constant, and growing a little bit, but
and I guess that's part of the bull thesis for like a Roku,
I
is
guess
making it all that stuff really easily accessible. Okay. Any other? You had two more, right?
So there was a tweet from Gavin Baker, who is a investment manager, very good, another good follow. There was a Forbes article about this low code platform that came out of stealth, and it basically is like an API kit type of deal. So he said that he thinks we're going to see a lot of low-code versions of every category of application software as a service. And he said it could be quite disruptive. Do you agree with that, where there's going to be these companies that make it so someone like us could say use Twilio, MongoDB, etc.?
Yeah, I mean, I think that's the way the world's heading, and it's like, it's even to go like a step further, low code even to no code. Like,
Yeah.
Wix uses low code, let's say, and makes it really easy that we don't have to code at all. I
And
think.
compared to what, WordPress or something like that?
Well, yeah. I mean, did you have to code for WordPress at all?
I mean, if you want to customize any design, you have to code, which makes it difficult. So Wix is a little different, where you can customize the design a lot easier by just dragging and dropping, picking things, and not actually typing in the coding language.
I think I think they're making it easier and easier to build. That's becoming pretty obvious.
Yeah.
I would agree with Gavin.
And that just, I'd agree as well. And that just, it shows to me that on aggregate, a lot of these software companies are valued like they have no competition and they have these giant moats. I mean, it just concerns me, because we know a lot of people that are investing in these businesses. They know a lot more than us, but it concerns me at these valuations.
Yeah. What's your last one?
Okay, we already hit on it, but there was a ton of talk about the flywheel being the most overused investment term over the last 5 years. Should we cut out the term flywheel, except for making fun of it? We can't seriously use it, because I think it's a cheat code. People are like, every company has a flywheel. Our podcast has a flywheel. We use the podcast, and then we post it on Twitter, and then we get some more followers on the podcast, and then it gets more followers on Twitter. It's a flywheel. Oh my God.
I don't know. It's is it as bad as Synergies?
Synergies is old, though. That's like Synergies is the godfather.
It's honestly, people are starting to interchange those two, and they shouldn't be.
I mean, if you interchange those,
like our Twitter accounts and our podcast have a lot of synergies.
Yeah, so many synergies, yeah. Or the YouTube channel. You can post videos at the same time.
That
so
adds to the flywheel effect.
Yeah. So I think it's cheating to use flywheel, because it's like you're not actually doing the analysis. Right. If you actually think hard, you can come up with a better bull case or bear case. Okay.
Next, we have an interview with Will Hershey. What was your favorite part about the interview?
I like talking about Roblox. I like talking about Nintendo. I think he may be wrong on Nintendo, that it actually is. We like Nintendo a lot, but he did give the case where they're a hardware business that is a lot of first-party stuff.
Provide hardware.
But I thought it was a good discussion. I mean, we hit everything on gaming. We hit a lot on gambling. His theories on that, he's kind of more of he has like a longer term time horizon on the gambling, the sports betting, things like that. So there's a lot of good analysis there, and that's what he spends his whole day doing. So he's kind of an expert on that stuff.
He's really well informed with like the whole industries.
Yes.
And as someone that's created an ETF, you don't have to be neck deep in the fundamentals of each business, but you just have to understand the industry as a whole. Yeah. And a lot of the adjacent type products, the industry tailwinds like Twitch, esports, that whole gamut. Okay. Here's our interview. Today we are welcomed by Will Hershey. Will is the CEO and co-founder of Roundhill Investments. We have a lot of questions for Will, so before we get to that, Will, welcome to the show.
Yeah, thanks for having me. Great to be on.
So right off the bat, how did you get your start in investing? Not Roundhill specifically, just investing as a whole.
Yeah, so both of my parents worked on Wall Street. So neither of these firms exist anymore. My dad spent most of his career at Merrill Lynch. Oh. My mom was at Lehman Brothers. So I kind of grew up very much so, CNBC on the TV. Yeah. And kind of just interested in the markets from a really kind of early age. I forget when my dad helped me open a Scottrade account, but I definitely was not 18. Maybe kind of reminiscent of what we're seeing with Robinhood right now. But right. I was introduced to it from a really early age. Both my parents were in fixed income, corporate bonds, and munis, but always kind of loved watching the markets from an early age and knew almost from day one that's what I wanted to do.
All right. Well, you've started Roundhill. I don't know what the established date was, but what is it? And then what urged you to start it and kind of go off on your own?
Yeah, so Roundhill, we're a registered investment advisor, SEC registered investment advisor, based in New York. My partner's actually in San Francisco. And really our core competency and really what we're trying to do is issue thematic equity ETFs, really targeting what we believe to be secular growth trends that really appeal to kind of a self-directed younger audience where people are passionate about these themes. They understand the companies and what the companies do, but really maybe should be more playing in a diversified basket as opposed to kind of stock picking. And that was kind of the groundwork for starting the firm. What made me decide to start it? So I actually connected with my co-founder back when crypto was going crazy. He was at his old desk trading investment grade credit. I was at that time, we were winding down an energy long short fund that I lost all my hair doing that because this was, people forget, like energy's had such a rough go for longer than the last couple of years here. I wasn't on that desk for minus $37 a barrel on prompt, but I was there for 26 and that felt just as painful. But we really said, even though there's thousands of ETFs out there, and there literally are at this point, we thought we could kind of do things really differently, really build expertise in the ETFs we're launching, as opposed to kind of the other model, which is throw out whatever's out there and hope something sticks that's kind of employed by the larger players. Really kind of take that expertise and package it into content. And one thing I'll say that's kind of interesting about the way we approach ETFs, which at the end of the day is about raising assets, right? We're not active managers. We're not fundamental stock pickers per se, is not doing any traditional outbound sales and not doing any traditional outbound advertising, if you will, but instead focusing on that content. And so far it's been going well. We're at about a little bit over 200 million in assets under management. Most of that is in those two ETFs, or two ETFs, one on esports and video games, the second on online betting. And we actually also did, I don't know if this shows up, it's not prominent on our website. We actually did a private investment as well, an SPV investment. So.
Okay. There was a third ETF too, right? The Deep Value ETF.
There is a third ETF. That's exactly right. Deep Value ETF. For our esports, which is nerd, ticker symbol's nerd. Nice. For our online gambling, which is bets, BETZ, we're actually the advisor to the fund. So we started those from scratch and launched them. In the case of Deep, it was actually an existing fund that was around for about 5 or 6 years. I think it was launched in 2014. And our kind of core thesis is around these thematic growth sectors. Clearly, Deep Value doesn't fit in that story. But we were given the opportunity to really take over that fund already with 20 million in assets, partnered with Tobias Carlisle, who you guys might know from FinTwit, to help us kind of pick the value basket, and saw, even though that's not going to be our core competency, and we're working on some pretty exciting, I think, thematics that fit in that bucket, it was just opportunistic. And, value is going to turn at some point. It kind of it was too hard to say no to take that over.
And you're giving people the opportunity. It's not like you're betting on Deep Value in itself. You're just giving people a vehicle to invest in it if they want to, correct? Is that how you kind of go about it? Or? Yeah.
Exactly. And Tobias could speak better to this than we can. Really, we're the fund sponsor, so our name is on it, but he's actually the index provider that we're partnering with him on. But really the thought there is, it's a pretty fundamental screen trying to identify undervalued companies. Factor-based systematic value investing hasn't worked for, call it, 5-10 years.
Yeah.
Eventually it will. I don't know what the catalyst will be, but it's basic. And we're actually undergoing a pretty interesting shift in that strategy now. I don't even know if I can. Well, we're going to shift things up and move to kind of even smaller cap than what the fund does now. Cool. That's where he sees the opportunity.
And so Tobias sort of picks who ends up in that index, and the ETF is just based off that, right?
And is that based off he acquires multiple stuff that he's been doing for years and years?
You got it. That's exactly right.
Cool. Okay, and then there's
there's one more question. You've been talking about this on Twitter. It's the Stunks app. I don't know if this is a social thing. It hasn't launched yet. Do you have any news about that or anything?
So we haven't launched yet. Hopefully we'll have it in the App Store for kind of a closed beta by the end of this month. But really what we noticed when, in the sense that our model is really going after the end client of ETFs, right? Whether people have advisors, going to the end investor, or whether you're even an institution, like trying to connect with people, we didn't really have a way to kind of interact with who the end investors were, or even to really know who they are. So we're working on Stunks App, which is kind of, and the name, we think the name's great, but we'll see what the response is there.
Right.
The whole thought is kind of playing off of this concept of creating a place. I think a lot of it takes place on Twitter now. A lot of it takes place on Reddit, but kind of creating this third place for people who are passionate about investing to talk about and to create a community around what people actually own, and almost act as kind of a third party verification. So I'll give you a little bit in the way that it works, but it connects via Plaid into people's actual existing brokerage accounts. And then we're doing things around what do people actually hold? Where did they place trades? And building a community around real portfolios, as opposed to what I think has been tried before, which is fantasy investing, which everyone ends up with the 3x levered nat gas ETF. And it's like, would you have done that if you were playing with your real money? I don't know.
Yeah. That's an interesting idea. I'm excited to see what it's like. Yeah.
It's like adding a social media aspect to your brokerage, or almost like spinning off FinTwit on its own, but you're actually verifying it.
That's kind of the idea. And I think you're starting to see this concept of social brokerage pop up, right? I don't know if you guys have ever come across Public or eToro. We don't want to compete with the brokers because that's too hard of a game. The customer acquisition, like that's not where we want to play. But to kind of have this third party that sits on top, whether you're, if one of us is on Robinhood, the other guy's on TD Ameritrade, to have a community to talk about real positions and holdings and trades. That's kind of the high level concept.
And it seems that since StockTwits kind of has, I don't know, I don't like going on there. It's just a bunch of, it's not fun to be on there at all. It seems like there's an opening that they kind of left open, that there's something there.
Yeah.
All right. Well,
we think so.
Yeah. Well, we'll get into the specific stuff you guys go over. Esports is the first one, I guess, gaming in general. Just before we get into the everything, like what is esports and how does it differ from gaming? Because I don't think a lot of people know.
Yeah. And I think if you asked industry people, depending on what angle they're coming at it from, you might get a few different answers. But if you're a purist, esports is kind of regulated professional gaming that takes place in organized leagues and tournaments, very similar to what we think of when we think of traditional sports. And that's a really exciting opportunity. You've got hundreds of millions of viewers worldwide, many of which are in China, Korea, EU. The US is just starting to kind of take hold. We saw a bit of that during COVID. But for us, we kind of take a slightly different approach because we think that's a little bit too narrow. And when we're talking about esports as it relates to our index and our fund, really we're looking at the broader concept of game streaming and really this second derivative of watching other people play that's starting to take hold, whether it's on Twitch or YouTube. And some of that isn't high level professional play per se, but also just kind of watching content creators. And for us, it's really kind of trying to capture this trend of games that's been taking place for a while, but games being, social and games being competitive and capturing that trend. And that's where we see kind of the excitement and future of gaming.
Yeah. I was one of those kids watching gamers, and some of the best ones weren't even that good at the actual game. They were just funny to watch. And so they're kind of like, I don't know, the typical more popular YouTube channels and that stuff. But I want to get into the actual esports teams. How does the business model work for that? How does the esports team generate revenue? And then how do the games or the game publishers benefit from it?
Sure. And I think I actually should point out, if anyone's interested, I'm sure everyone's an investor that's listening in. If you can invest foreign, there's actually a couple pure play esports teams that are actually publicly listed right now. So if you're interested to dig down in the financials, see what it looks like, Astralis, which is one of the best Counter-Strike teams in the world, is listed in Norway. And Enthusiast Gaming in Canada is the parent of Luminosity and a couple of the Overwatch and Call of Duty teams. So you can actually dig in and look at the financials yourself. But I kind of see there being, and this comes back to exactly what you were just mentioning, Ryan, which is there's kind of two different models that are taking place with esports teams. You have the kind of content creation model, which is what, if you've ever heard of FaZe Clan or 100 Thieves does, which is really kind of shorter term, more P&L focused, but kind of taking this approach that gaming is actually different than traditional sports. And let's maybe not try and necessarily in every game be the best professional team, but instead, to your point, get the most exciting content creators that draw the biggest crowds every time they go on Twitch or YouTube or Facebook. and monetize them via merch drops, via ads. So that's one model. The other model that I think kind of is more traditionally what you think of as esports is what Cloud9 or G2 Esports does, which is try and build the best, the New York Yankees of League of Legends or of Counter-Strike. And they're two very different models. For the latter, actually, you're actually seeing franchise slots that are being purchased in these different leagues. Oh. So the same way that when there's an expansion and the New York Tech and the Houston Texans joined the NFL, Activision Blizzard was selling franchise slots, like to have a seat, to even be in the league, they were selling them for 25 million a pop. League of Legends, depending on what region you're in, was going to upwards of 10 million too. In terms of how they monetize, it's very similar to traditional sports on the pro esports side. The second group I'm talking about, it's sponsorships. And a lot of them are endemic, right? It's guys who make mice or keyboards or Monster Energy. Right. It's advertisements. In a normalized environment, you've got ticket sales and merchandise sales. And then for me, the most interesting component is media rights. So what you're seeing now is, coming back to the first grouping, individual content creators. All of the biggest streamers in the world, whether you're in Asia or in the US now, are under multi-year contracts with different platforms. So you might have an exclusive deal with Twitch if you're Ninja. You might have an exclusive deal with Huya if you're a popular Chinese streamer. And the media rights are not only growing for those individual creators, but they're also growing for the proper esports leagues as well. So last year, I think it was earlier this year, Activision signed a pretty big deal, over 100 million for a few years with YouTube to be the exclusive to YouTube to get the exclusive rights for the Call of Duty League, Overwatch League, and Hearthstone. And the teams then, same way we have in traditional sports, are kind of going to do a revenue share model. And that's typically how the pro esports teams will kind of make money. And when I look at, I think your last question was, how do like the game publishers, game developers benefit themselves from esports? I think the biggest kind of higher level concept here is esports and like the kind of the glamorous events that are put on a world stage are some of the best marketing you can possibly do to bring people into your game. And more importantly, from a business standpoint, I look at a game like Counter-Strike or League of Legends. These games have been around for more than 10 years. And why are they continued to be played and iterated on? Part of it is new content is now delivered digitally, but it's also, esports, I think, and watching the highest level of competitive play increases the longevity of how long these games are popular. And that's the holy grail in terms of what the business model can be.
Okay, so I'm thinking about it like typical sports. So like a Call of Duty or something is sort of your NFL, and then esports teams can sign up for spots in that game publishers league. Am I getting that right? Or that games league specifically?
Yeah, I think the nuance there is it's on a game level. And I think what you're kind of alluding to is the difference here is there's an Activision Blizzard that literally owns the intellectual property, owns the game.
And no one's no one owns football. Sorry.
No one owns the sport of football, right? Like we could get a few buddies and start a pickup football league. We can't do that and start a pickup Overwatch league unless we get sign off from the publisher. So the game publishers, the game developers are in a unique position to accrue and kind of get the most amount of value of everything that comes with esports. And it's kind of this push pull of how do they do that in a way that they're allowing the other stakeholders to kind of grow as it grows.
Okay. Now I want to talk about, I want to get into games as a service and then the gaming engines as well. I believe Tim Sweeney was asked at one point, is Fortnite a game or a platform? So I'm going to ask you that question. Do you think Fortnite is a game or a platform? And then how do you see them sort of, we've seen incidents where there was concerts or movie previews or the anti-Apple message. How do you see them continuing to leverage that? Is there any other areas they can expand to?
Well, I'm assuming you guys know that was me that asked him that question, right?
Was that
you?
you?
Really?
Yeah,
I
that
didn't
was
know
me.
that was
No
you.
way, no way. Wow, no, we
That
did not know that. We just
Okay, yeah, that was me. So as you can imagine, I have some thoughts. I should also mention the private investment we made is in Epic Games, so I
Okay.
should just mention that.
Okay.
But is it a game or I mean, you better believe my plan is to re-ask Tim, because he asked me to ask him again in 12 months. So I've got it on my calendar to tweet back at him to get his thoughts. But I think it's becoming abundantly clear that Fortnite is not just a game. I think you could say the same for Minecraft. You could say the same for Roblox. You could say the same for Grand Theft Auto. And it's really becoming number one. Fortnite is kind of, I don't know how old you guys are, but for me, I grew up messaging my friends after school on AOL Instant Messenger. Now, kids will get on with their friends and communicate with their headsets on via Fortnite. And I think in that sense, it's taking over social. But in terms of this concept of it being a platform, which it definitely is, I mean, you talked about some of this, but they're now doing a concert series within the game. So to attend the concert, you actually have to log in as your avatar and attend a certain part of the map to watch a concert. We saw this with Travis Scott. We saw it with Marshmello.
And are those
concerts?
Are those concerts free, or do you have to have the battle pass or whatever it is, the subscription?
They're free. They're fully free to go watch. And it brings up this interesting question of, I actually pulled it up. If you look at the Google search trends for, I think both Fortnite and Travis Scott after that concert, they both peaked, like they both went up. So It didn't only bring Travis Scott fans that wanted to watch their favorite artist into the game of Fortnite, it also introduced Travis Scott to gamers that maybe weren't familiar with his music from all over the world.
right.
And I think in that sense, it becomes such a powerful platform. And the lowest hanging fruit, at least right now, just given that they have it in place, is as a platform for music artists. We also saw with Star Wars last year, super cool integration where they previewed the video trailer for the movie inside of the game once again. And in that case, you'd have to imagine, I don't know what Star Wars is paying Epic for that, but something. They took it a step further and actually introduced lightsabers for characters instead of that typical axes in Fortnite. And like what you can achieve there, especially with a younger demographic, in terms of like you feel more of an emotional attachment to whatever the brand is or the activation that's being done in the game. If you get a lightsaber or an item from it or a character skin, it's very difficult to try and quantify that, but it's just so powerful. And we're truly seeing like this world being built, this metaverse being built, where so much is going on outside of the physical world, but in the digital. It's pretty amazing.
So
Right. Go ahead, Ryan.
Do you think it's better that Fortnite continues to make that free for the users to see, because it's basically marketing for the artists or Star Wars? Or would it be better if it was only people with the battle pass?
I guess you could see them start to monetize certain exclusive events via battle pass, but I think the whole industry is shifting towards this concept of, you alluded to it earlier, games as a service, and having most of the content within the game being free to access and free to play. And I think that's just that's just like a numbers game where it's better to have more users than not. I mean, this is very similar to a model that we're seeing employed kind of throughout, right? The freemium model concept is not new to gaming per se. It's, you can get a certain amount of service by doing the free version, and then they try and upsell you, whether it's, we're on Zoom right now, I'm on the free version, right?
Yeah.
Similar high level concept.
Okay, well, I guess that transitions to this next question here. Do you see this working at all in any other businesses, or is this something that is unique to gaming in general?
Yeah, I mean, I think I just highlighted there that it's not necessarily unique to gaming. I mean, in terms of the world of entertainment, just think about going to a public event or a public concert or a public fair where it's free to go, but you're going to buy a beer and a hot dog and it's monetized that way. Yeah. It's a little bit different conceptually to think about that the beer and the hot dog isn't physically in my hand. Instead, it's some digital cosmetic. And that's kind of a thing that I think, younger generations that grew up living on an iPad can appreciate better than maybe we could, and certainly the generation above us ever could.
Right.
But I think when you look at kind of free to play, there are going to be different monetization tools that are unlocked on mobile. For example, if you guys ever download a free mobile game, by the way, the game I'm like obsessed with now is called Archero. I can't stop playing it. They're going to serve you ads in between
right
gameplay, and that's just a low-hanging fruit. And I think the next iteration there, we're starting to see this, and it's been done, but is within these truly immersive worlds. So imagine a Grand Theft Auto, you're driving down the street and one of the billboards has a Sprite advertisement on it, or you could just see where that goes. And as people spend more time within the game, the opportunity for that and to monetize it becomes better. Just you're never going to get a more engaged eyeball than someone playing a game. It's just so much better than someone watching TV because they're actively involved in it. And that makes the advertising potential kind of crazy to think about.
Do you think that at some point, like the whole industry will go the way of like free to play and then monetize in game, or will there still be a blend where you've got the EAs and the Call of Duty you still have to pay for?
There's two versions. There's Warzone, which I guess I would love to hear your thoughts about Warzone. I think it has a huge amount of downloads right now, and it's like maybe one of the most popular games currently. I think I saw that stat. But yeah, there's also the Play Call of Duty that they release every year. You have to pay for it.
Do you think those publishers will go the way of free to play?
I think in those two that you mentioned, so like EA Sports franchises and Call of Duty, I mean, I think they could. I think where you'll continue to see like $60 box titles are kind of like single player, immersive, long storyline games that aren't social. And insofar as those stay, really there's maybe not as much room for in-game monetization. And there it's such a it's less of an iterative process where you're continuing to push content digitally as much as it is, here's a great story that feels like a movie that you can play out, whether it's God of War or Assassin's Creed or whatever it is. It's not really meant to be social, but like we spent a lot of money developing it. I think those can probably still stay where you pay something up front. CD Projekt is releasing Cyberpunk, which is like probably the most sought after game in years. And that's going to be pay to play. But yeah, I mean, you could easily see, I mean, just think about Madden, and this is even a better business model. Think about Madden. Instead of buying the game each year, you pay a subscription to EA to play all the sports games, $5 or $10 a month. And they just update the players. I mean, that's all you're buying when you buy a new Madden anyway. It's right. It's like you're buying the rookies.
Yeah.
No, that makes sense. All right. Well, I guess that was enough on the game as a service. But another thing that's popular right now with Unity's IPO is the engines. So could you talk about the difference between Unity and Unreal's engine and whether there are any other entrants in the marketplace, just kind of the engine market in general?
Sure. And let me caveat this with saying I'm not an expert when it comes to game development or game engines.
Okay.
But my general understanding is that Unity is really going after a different market than Unreal is. I think if you look at like the top AAA really immersive games, they're going to more likely run on Unreal, whereas Unity is really going after the super casual games that are going on mobile. And it's just going after like really different markets at the core. I think that's probably the biggest difference. They really kind of just serve different purposes, but the two of them control the large majority of the market, right? At the really big publishers, they'll have in-house engines as well. But in terms of engines that are kind of being utilized by third parties, it's Unreal and Unity, and that's kind of how I would classify it. Unity is a Toyota and Unreal is a Ferrari.
Are they trying to
analogy work?
Yeah, that makes perfect sense. Are they trying to overlap with each other, or are they pushing into each other's market at all, or have they been staying separate for the last at least few years here?
My understanding is that they're really kind of going after different segments of the market. But like I said, others who have covered Unity in depth probably better than I to speak to that. But both can win. Let me tell you, I think mobile is the fastest growing and probably most exciting, generally speaking, part of the market. But it's just very different from building a beautifully looking game that needs to run at really high quality.
Yeah, it doesn't seem like it'd be a zero sum space. Okay, so next question. Unity and Unreal have both, and we have gotten this thesis because I was an EA shareholder for a while, and people were like, well, Unity and Unreal are going to lower the barriers to entry. It's going to be really easy for these smaller developers to develop good games, and that's going to steal market share from the bigger guys. Is that have merit to it, or do you see the incumbents still being able to kind of hold their own?
It's a great question. And coming back to my last kind of response, I think, Unity is the one of the two that's more likely to have an impact here in terms of offering that kind of lower cost, engine and operating model to clients. I think I can answer this kind of both ways, but I think you're definitely, there's no question that you're seeing indie developers that are coming out with more hits than ever before. I mean, look at, I don't know, if you go on Twitch right now, if anyone that's listening goes to twitch.tv, I would guess Fall Guys is among the top 10 games being watched. Among Us is among the top 10 games being watched. And those are from developers that don't have the budgets anywhere near an EA or otherwise. So I think that the games industry, the short answer is yes. As the tools get more efficient and cheaper to use, it allows lower barriers to entry. But I do think that that's expanding the market rather than kind of cannibalizing the existing players. Because when you look, let's just use a Grand Theft Auto as an example. That's hundreds of millions of dollars in R&D costs to get GTA 6 and years of development too, right? Like if you're an indie developer, you don't have a low enough cost of capital or a long enough runway to try and compete with that. But for these kind of less kind of like non-AAA games, it definitely makes sense. And I think it's kind of fascinating to see all of these new entrants like come up with these really simple games. Like if you look at Among Us, the graphics are like go back 20 years, but it's just really? it became viral. Okay. And that opportunity is there.
So it might be more one-hit wonders, but it's not going to have the staying power of a GTA, Call of Duty, or FIFA or something like that.
Yes, but I will just add to this that there's really smart venture capital firms that are focusing on indie developers because, I mean, look at Epic Games before Fortnite. I mean, they had Unreal Engine and they had Gears of War, but like that's one example. Look at CD Projekt before The Witcher. And, look, even a better example, Among Us, the company that developed Fall Guys, had been around for, I think, 10 or 15 years, and then they finally got a hit. And they hadn't had anything like this over that whole period. So, like, it's a very attractive investment space in indie developers for early stage.
Right. All right. And then I guess we wanted to talk about a few more publishers. C Limited is very popular right now, probably because the stock's up like 800%. I know this is only like a third of their business, but why was Free Fire so successful for them? And is that success repeatable at all? Or is that maybe, is there a potential that it could be like a one-hit wonder?
So I think I could narrow it down to a couple main reasons. Okay. I think what you saw with Free Fire was the game was designed. So it's a battle royale game, right? Similar to PUBG or Fortnite. There's many battle royales, Apex Legends. There's many battle royales out there. For them, they're focused on, it's only on mobile. And they designed the game to run on lower end hardware. So in doing so, I don't know, I forget the exact, can you run it on iPhone 5? I forget, but you get the idea. In doing so, they developed a game that was able to target emerging markets. So the biggest markets for Free Fire are very different from what they are for Fortnite. It's Latin America and Brazil. It's Southeast Asia and Indonesia and Vietnam and Thailand, where smartphones penetration rate's gone up a lot, but they don't have iPhone 11s. And in that sense, going after that underserved market, I think totally was why Free Fire took off in the way that it did. Not because it's necessarily a better game than Fortnite.
That's very smart. Very, very smart business move there. Yeah.
Do you think?
No, totally.
So you said it can run on sort of the older devices. As those more emerging markets start to adopt better tech, does it stay with the technology as it gets better, or do they have to revamp that game over and over?
I guess we'll kind of see. In Free Fire's case, they've released like a better version. I forget what they call it, if it's Pro or something like that. And PUBG's done this too, where they have PUBG Lite, and it's all about kind of building these for different markets where just different qualities of smartphones are. But for C, I mean, they recently acquired another game publisher, and I don't know whether they're trying to develop another Free Fire. If I was them, I wouldn't even try and worry about it. Continue to monetize that, grow the user base more than they have in kind of these different markets that people aren't paying attention to. To me, the big question for them within this gaming vertical, and you guys mentioned it, but the story of the stock is no longer fully gaming, is can they increase revenue per user? Because they have tons and tons of users, but if your users are in India or Brazil, they monetize at a lower rate than US.
Right. That makes sense.
Now you did, if I'm not mistaken, you left Nintendo out of the nerd index. Why is that?
It's a good question. So even though it's an index-based product, really what we're trying to target, as I mentioned earlier, is kind of this concept of social gaming and esports. And when you look at Nintendo, they're probably as anti-social gaming and esports as any major publisher comes. In fact, I think a few years ago, they actually, for a brief period, and then they realized this was really dumb, banned streaming on Twitch of all their games. And it's like, it's probably the best marketing you could ask for, but they kind of didn't see it that way. So for them, if they ever kind of take a stance where they're pro esports and leaning into it, I mean, they do have Super Smash Brothers that has a pretty big community of professional play. They would have a chance to get in. I will say that maybe a lot of people don't appreciate this, but Nintendo is a hardware business currently, right? It's not a software play. It's their business right now is selling Nintendo Switches.
Yeah, that, I mean, there are the game downloads for the Switch, but the thesis is definitely still Switch centric for any Nintendo shareholders. But
I would think that's the case for the next couple of years. And for just to further this, Nintendo is still doing that old model to a large degree, the $60 or whatever the cost is out of the box game, rather than taking advantage of kind of digital distribution.
Right. All right. And I guess on the other end of the spectrum is a startup called Roblox. It was actually, we just got some news that they're planning to go public in the first quarter of 2021. There's someone that everyone plays, as I think the stat is under 13 spends more time on there than YouTube. But can you explain what they do and why people, I guess kids especially, are spending so much time on Roblox?
Yeah. So Roblox fits into the same category I put in Minecraft or Grand Theft Auto, and going after very different age demographics, right? Grand Theft Auto is mature, Minecraft is maybe in the teen area, and Roblox is really going after younger kids. If you open up Roblox, like the graphics are nothing to write home about. It's really just built this kind of amazing community of user-generated content, and that's how it's all built. So I haven't spent much time in there, speaking frankly, but it's all about games inside of the platform or inside of the game that users themselves have built, and they might be very different from one another, right? One might be a shooter, another might be an adventure game, all built within the Roblox ecosystem. And I think why it's been able to grow so well is it's kind of playing off of this concept of a creator economy that that's part of the reason why social media has expanded in the way that it has. Right. And it provides a platform, for its users to monetize themselves. And yeah, when you look at, if you ask anyone that you speak to that comes on the podcast that's in their 40s or 50s that has kids, they'll know Roblox because every kid is playing it.
I mean, the hours spent on there are absurd, and it's weird because no one in the investing community, maybe it's because they're not public, has really heard about it, and they're almost bigger than YouTube for a lot of demographics.
So does this make it into the index as soon as it goes public?
Well, I can't comment on that.
Right.
But it certainly checks the box as being a social gaming platform. Let's put it that way.
Okay. All right. Well, we're going to move away from gaming and more into the gambling/sports betting. And there's obviously a lot of hype surrounding sports betting right now. It feels like one of the most, I don't want to say hypey markets, but it's definitely, people are talking about it a lot on Twitter.
Yeah. Portnoy and Penn National they're basically throwing gasoline on the fire, right?
So why did you guys start the ETF? What do you guys like about the sports betting market?
Yeah, so we We started working on this fund late last year, early this year. We didn't actually launch until June, so we've only been out there for about 4 months. And it's funny, I'll just share an anecdote with you guys. So whenever we have a new ETF idea, we have to present it to the board that oversees the ETFs. And I think we presented it when like there was literally zero sports on, and they were like, "Are you sure you want to go forward with this?" We said, "Yes, it's a long-term opportunity. It's not about this quarter or next." For us, I think, in 2018, basically you had a PASPA overturned, and that made sports betting legal on the federal level. Last year, New Jersey kind of paved the way and showed what you could do in terms of tax revenues. And for us, we made the decision early this year that, this looks like an industry that kind of checks all the boxes that we saw in esports. And not only is it a long-term secular growth story in the US, but it also has catalysts that we expect in the term of kind of everything's done on a state-by-state level. So you're going to have catalysts as states kind of regulate and legalize their betting markets. And for us, the other reason we thought bets was kind of really compelling was a lot of the names in our portfolio aren't US. In fact, I think US is somewhere around 30 or 40%. It varies day by day based on price performance. But a lot of the interesting companies are listed in Sweden or listed in Australia or the UK. And for us, that's going to be part of the math too, is can we offer a compelling product that actually adds value to our investors? This checked the box there. And then we saw, the SPAC acquired DraftKings, and it just kind of all came together in terms of timing. But we think it's a really interesting long-term story.
Yeah, I was going to say that. I guess you'd know better than me, but I feel like that ended up being pretty good timing on the launch.
Yeah, I mean, I think we could have done better if we did it on March 12th or whatever the low in the market was. Right. But no, it performed very well versus the various benchmarks. And it's like, to your guys' point, it's like almost every day that something related to one of the portfolio companies is in the news.
Okay, so just broadly, I want to know what you think of Penn's acquisition of Barstool, because a lot of people have obviously talked about that one. And then how else do you see some of the other sports betting companies getting that social aspect that Barstool has sort of cultivated through their brand?
Yeah, so I actually wrote a whole blog piece on their acquisition. So it's on our website if anyone wants to go in and read it. But I think that it was a great deal. And I think we won't really fully be able to appreciate how good of an acquisition it was for a few years. But I don't think I can ever recall an acquisition where the parent company bought basically a bolt-on deal, right? This was $150 million-ish cash investment. They do have the opportunity to go above 50%, but for 36% of Barstool. And Penn is a well-established company. They operate tons of casinos throughout the entire U.S. I forget what the enterprise value was. I write it in the blog there, but this was like a tiny acquisition that changed the entire story of Penn kind of overnight. And if you look at the performance of the DraftKings and PointsBets and GANs of the world versus the legacy brick and mortar guys like Boyd or MGM or Wynn, Penn is now trading like it's a completely digital company. Now, obviously it's not, but they did one small acquisition and it completely changed. And I think for them, it's really interesting what they're doing, because effectively when they bought Barstool, obviously they launched the Barstool app last month and it completely crushed it in terms of expectations for the first couple of weeks. They're taking an approach that Barstool is now their customer acquisition tool. Barstool is now their top of funnel. And very different from FanDuel and DraftKings, who spend hundreds of millions of dollars per year to get those same customers. And just to come back to your earlier question, what they're doing with making it social is they're having bets that are actually based off of the various influencers, right? So Big Cat will sponsor a certain bet, and so will Dave, and so will PFT. And the ability to kind of create these narratives around individuals is like very unique to them, but other sports betting companies are doing similar things. You're just not hearing about them because no one's as loud as Dave. Right. Right. Like FanDuel has something with Pat McAfee, Jamie Foxx just did something with BetMGM. Others are trying to do stuff.
They're partnering with someone's partnering with the Ringer. I can't even remember what, but yeah, something like that.
No, there's so much. And then the other partnerships that's taking place are with legacy sports media companies. So NBC has a deal with PointsBet. Fox has a deal with Flutter, William Hill, and CBS. Every sports media brand that we think of now, DraftKings with ESPN, you're just going to see sports bets and lines and odds like baked into everything that you can think of in terms of television broadcasts, streaming, whatever.
Yeah, I mean, and then there's been a lot of hype about this for sure. I mean, there's been a lot of acquisitions, all these deals, and that has brought on the skeptics. I think I saw Jim Chanos on Twitter being publicly skeptical about it. There's been a few others about how big the sports betting market will actually be. What are the strategies of these companies, Penn National, all the other ones you listed, and what has been working and what hasn't?
Yeah, so I think when we look at the opportunity set for U.S. sports betting, and the broader opportunity here is a shift from in-person, physical, brick and mortar gambling, whether that's casino or sports betting, to digital and to mobile and to online. And it's obviously a higher margin business than running an in-person casino. It really becomes a question of software. And just to give you one more point here, gambling is the largest form of entertainment globally. Gaming is really big. Video games are really big too. 150 billion, growing 10% a year. Gambling's 500 billion globally in gross gaming revenues, the biggest by far. And in terms of what the strategy is we're talking about the U.S. I think is what Chanos was referring to as well. It's very difficult to peg a total addressable market here because it's all black market. It's all unregulated. I think you're seeing varying estimates from the sell side. I think the general consensus is it's measured in the tens of billions. But right now where we are is it's completely a land grab. And that consists of two things. One, trying to get into new states as they allow for it as soon as possible. And companies like Penn are really well positioned because they have physical presences in these states already and have relationships with the regulators. And then the second is once you're in these new states, grabbing market share and spending tons of advertising dollars on it. When we get to kind of maturity, these can be very profitable business models for sports betting. I think Morgan Stanley says 25% EBITDA margins, but the long-term play here, I don't think is sports betting. In the exact same way that daily fantasy for FanDuel and DraftKings wasn't the long-term play, that was the customer acquisition. I think sports betting leads into iGaming, which is online casino, whether it's online slots or online poker or online blackjack, because that is the kind of the really holy grail, great business model, predictable margins, recurring revenues here. And I think that's where we'll eventually, we're already seeing it, right? DraftKings has DraftKings Casino in the few states. The thing with iGaming is it's going to run on a different schedule from a regulatory perspective because regulators view in-person betting and online casino as different things. But that's one is really the long-term play here is iGaming. And for me, when I look at sports betting, I could actually even see sports betting get to a business model where you're talking about zero vig. So if you guys have ever placed a bet, you usually bet 110 to win 100. Mm-hmm. I could see it move toward, and that's how the books get their hold. Yeah. I could see that move towards zero vig, bet 100 to win 100, where instead of being monetized based on generic bets, users are monetized based off of kind of parlays and futures bets and their data. Very similar to what we've seen in online brokerage in the U.S., where Robinhood makes money not off of you trading because it's free, but on trading options and selling your order flow. Yeah. And then the last thing, I know I'm going way too long on this probably.
No worries.
But the last thing that I'm really excited by is live betting. And I just tweeted about this today, but I think that if and when we will perfect live betting, and it's really important that you have no lag when you're watching a sporting event, and streaming is typically runs on a little bit of lag. But like if you can bet on whether the next pitch is a fastball or whether the next play is a play action, and have that integrated into the viewing relationship in a very involved way, now you're talking about like a totally different mindset for how people consume sports and having it really being gamified for the individual user, which I think comes back to the broader thesis of why we like esports and gaming. Now you're talking, and don't get me wrong, very heavy legwork from a data perspective to properly price that and make sure you don't lose money. But that's like the holy grail. And think about it now beyond sports. Let's say watching the debate, we could bet when the fly is going to come. You know, it's just like, that's like we can't even contemplate, Tam.
Okay, no, that makes sense. And if it got legalized in Washington, so right now we're kind of restricted. If you want to do it, you have to use, black market sources, or pretend that you live somewhere else. But in Washington, if they had it legalized and there was zero vig, I would definitely go to the one that had zero vig. So I think it makes sense that I might go there eventually, just because the competition pressure bringing everything down.
Who do you think would be the sort of leader in the in-game sports betting? Is that still the Barstools of the world?
So it's interesting. So like Barstool and Penn rely on a Swedish company, which is publicly listed actually, called Kambi, for their backend, for their data, and for their interface. So it's not always the front end provider. In fact, a lot of times they're just putting on a different logo and different look and feel to the same kind of data sources. In terms of live, I don't know well enough who's leading that charge. It's not a new concept, but it's really getting that concept ported to mobile and taken to the next level, right? It's one thing to be able to bet on the updated spread at halftime or during a timeout. It's a totally another thing to take it to like literally what type of play are they going to run next. And that's where I see the opportunity. I don't have an answer in terms of who's going to win that one.
Yeah, it seems like it's a difficult problem to solve, but when it gets solved, there's going to be a lot of market opportunity there. All right. You may have answered a little bit of this, but last question: are there any, or at least on the gaming industry, are there any of these traditional ones? MGMs. I think there's some in Macau, in China, that are very traditional. There's Wynn Resorts. Do they have any advantages over these digital first companies, or are these digital ones, do you think, going to just continually grow market share over them?
Yeah, so I think there's something to be said. It's hard to talk about this during COVID, right? Because it's like no one's in there are people in the casinos, but it's not like what it normally is. I think there's something nominal to be said for having the relationship to kind of cross-sell people between getting them to go to your casino and having them in your app. But to me, the bigger thing relates to this concept of regulation and skins, and having kind of early access to different markets. And I think when you look at the different players, actually, believe it or not, Penn is in a ton of states versus some of the other larger players you mentioned that are really focused on the Vegas Strip. So I think Penn is pretty well positioned there. But I think, the digital guys have an advantage in the sense that their cost of capital is so low right now, right? Like I tweeted this today. DraftKings raised $1.5 billion and, barely diluted shareholders. Like, how can you compete with that? I guess Penn did an offering too, but
yeah, I mean, I think it was smart. I mean, I haven't looked at Penn's balance sheet that much, but I did see they had a lot of debt. So having this inflated share price and the other companies having inflated share prices, it might be smart to do these share offerings just to get some more capital in.
Yeah. All right.
I agree.
Last two wrap-up questions, and we asked this to all our interviewees. I'll go first. What is one financial saying that you disagree with?
Yeah, and this one hits close to home because I, at one point, was trading MLPs, Master Limited Partnerships, which people bought for their yield. Is the saying, "I'm getting paid to wait," because you're getting paid to wait, 6% yield, awesome, but the stock just dropped 7% yesterday. So who's getting paid what?
Right. No, that's good.
Yeah,
all right. Yep. Yeah, I don't think anyone's had that before, so we're always glad when someone comes in with a unique answer. All right, last question. What's one piece of advice you have for someone starting out in the investing world? So not just investing, but like a career in investing. I hope that doesn't.
Oh, a career in investing,
or just any advice
or
for investors.
or yeah, you could broaden it out if you want.
I can do both. I mean, I think a career in investing, probably the most important thing is just to really have a passion for whatever part of the market you're in, whether it's operations or trading or research. Because I think a lot of people come into this industry just because the allure of potentially making a lot of money and what they see on TV and in the movies. I think at the end of the day, it's still a job, and you got to try and find your niche that you really love. And that would kind of be it.
All right. Yeah, that sounds good.
All right. Thank you for joining us, Will. Had a good conversation.
Yeah, great time.
Loved it.
Thanks for having me.
Welcome back in. Thanks again to Will Hershey for joining us. Had a blast, but time for hot water. I have 3.
So do I. I always forget whose turn it is to go first, but
how about we can alternate on this one?
Yeah, but we say it every. Oh, okay.
All right. The physical world is in hot water.
All right.
I don't think you have this one because now
probably not.
Even dentist appointments are being done virtually. So patients are attaching a special scope to their smartphone camera, opening an app, and sending videos of their mouth to their dentist or orthodontist. Is that too far, or is that more validation of like the Teladoc type business model?
I don't know if it's about. I mean, Teladoc I think can succeed without this. It seems strange.
I saw the article headline and I was like, all right, orthodontist, dentist appointments virtually. That's a little weird. And then there was a video with it of someone's mouth, and it ruined it for me.
Yeah, I don't want to see anyone's mouth. I don't want to see the inside of anyone's mouth.
All right, you got a first one here?
Yeah, first one. FedEx and UPS. Amazon Logistics is actually going to deliver as many packages in the U.S. this year as UPS, and 50% more than FedEx. What do you think about that?
FedEx value play?
No way, dude. They're gonna.
You remember that day there? I think it was FedEx, maybe it was UPS. One of them got their stock literally cut in half overnight when Amazon said they were going.
The only reason they're staying in business is because Amazon wants to invest in this slower than people think. If Amazon wanted to invest and destroy the entire industry, they would invest 10 times as much as they can because they have that capital and they have the ability to. They could raise money. Okay, think about them raising equity. What are they worth? Almost 1.5 trillion right now. They can raise at a little bit of a discount to their stock price and raise $50 billion, or not 50. $25 billion in equity and build out the entire.
They can
UPS
raise a
and
FedEx.
They can raise a FedEx and a UPS overnight and basically take them out. I mean, they're dead. UPS and FedEx are dead unless government can step in. But
Catholicism is in hot water for me. I don't know if you heard about this because they're a bit under duress right now. This week it came out through financial documents that the Vatican used charity funds to buy risky credit derivatives on Hertz, the car rental company.
YOLO trade calls on Wall Street bets.
They bought default swaps, basically betting that Hertz wouldn't default on their debt by April 2020. They declared bankruptcy a month after, and they bought these, I'm pretty sure, in 2015.
Oh my!
They escaped by a month.
Yeah, it's in God's hands.
First of all, did you even know the Vatican is running an investment fund?
Yeah, I know. We need to get on that. They have an endowment or something. Yeah. Man,
the hedge funds aren't chasing these guys.
Yeah, that's a long-term. I don't even know. There's so many dumb jokes you can make about that, but
the Pope. I guess this was under the old Pope, but the new Pope. Am I getting that? Yeah. In 2018, stated basically these things are a ticking time bomb. Default swaps are a ticking time bomb when they had them on their books.
So he must have not even known. He's like the president of Lehman Brothers.
Yeah, I wouldn't go that far, but yeah.
You know what I mean? When he was we're clean, we're good, and then
it wasn't him that put them on the books. I'm sure someone runs the fund, but
yeah,
I guess neither was the president of Lehman Brothers. But
either way, bad luck. If you're gonna do, you're doing the same.
Funniest headline,
same, yeah, great headline. Same trades. You're doing the same trades as Robinhood YOLO traders, as they call them. That usually doesn't end well, especially with a big institution.
Yeah. All right. What's your second one?
Okay. Will Mead, who I'm using his real name because he has 100,000 followers and apparently a ton of AUM. He is the only guy in competition that's worse than Ross Gerber for not having money. No, I'm going to read this tweet for you. This guy, okay.
It's Ross.
No, watch. Let me read this tweet. 1,300 likes. The 13-13-13 rule is the secret of investing. Whether your age is 17, 27, 37, 47, 57, or 67. $13,000 invested at a 13% return a quarter or 1% a week for 13 years turns to $7.2 million. Financial advisors, hedge funds, and international bank, and investment banks know this retail. This is an incoherent sentence. He said financial advisors, hedge funds, and investment banks know this and retail doesn't. How? Long stock ETFs and puts as a hedge. I think he's up there. That's bad, right?
Dude, if he gets on FinTalk, it's over.
Dude, he has 100,000 followers. So 100,000 people, well, 10,000 people, 90,000 bots are seeing this bullshit. Dude, long stocks and puts as a hedge? What is that? That's a two-step strategy.
He also had that long-ass take of, I'm going all cash. If I were you, I would liquidate all your belongings and, go cash.
Yeah.
At the low.
At the low, yeah.
The take was but it was completely wrong, and that's why you don't do that.
Dude, it's just, how are people giving... I hate to bash, but this is fiduciary responsibility.
It's a fake account. It's Ross Gerber's burner.
Dude, this better be a fake account.
Okay. Robinhood is in hot water because they always are.
We got recommended this one, right?
Yeah. Article came out this week citing that multiple Robinhood accounts were hacked and looted. The article starts like this. It took Soraya Bagheri, I might be getting that wrong, a day to learn that 450 shares of Moderna, that's on her, she shouldn't, whatever, had been liquidated in her Robinhood account, and that $10,000 in withdrawals were pending. But after alerting the online brokerage to what she believed was a theft in progress, she received a frustrating email. The firm wrote it would investigate and respond within a few weeks. Now her money is gone. This happened, I believe, to 5 others that cited the same complaints, saying that they saw the funds being withdrawn but couldn't do anything about it since Robinhood doesn't have an emergency phone number.
Yeah.
Who even, get off Robinhood?
Yeah, please get off. If you're listening to this and you use Robinhood for anything outside of your betting account on options, which you should be using with not any sort of percentage of your actual net worth, get off and start using Schwab or TD or anything else, please.
Yeah. Sometimes, though,
it's awful.
So apparently this wasn't a hack through Robinhood. It was they got through the email used for the Robinhood account. And yeah, I think Robinhood's at fault, but sometimes I think the users are at fault. You should know to be off by now.
Yeah.
They get slack. Robinhood ends up having to take the blame for some really stupid users sometimes.
True. But you shouldn't be using Robinhood in the first place. If you're using Robinhood...
And by the way, they just got an $11.2 billion valuation. Right?
Yeah, I think that's because they're basing, not to go on a whole nother topic, but they base that valuation off of users, and we're technically both users. Plus Brady. Brady, you're technically a user? You're nodding? Correct. Brady's nodding his head. 3 users on there. Right, but they're probably discounting at what worth to be $5,000 per user. We have no worth.
I literally have no money on there.
Yeah, I have no money on it either. I have $4 maybe. Or no, I have none. I have none.
Money on there.
Yeah, I have none.
I use it to look up stocks because I like the user interface.
Yeah.
Okay. Did you have any others?
Yeah, this one actually just came out today. This is from Zero Hedge, Newswire. SoftBank says Vision Fund planning SPAC in 2 weeks. That's just an orgasm of a sentence right there for financial Twitter.
You know what? I am looking through the rest of my notes, and I forgot to do a fuck, marry, kill. So I'm thinking of it right now. I'm gonna use the SPACs. Okay. Open Door, the new SoftBank one, and Playboy.
Oh, killing SoftBank because they're there's no evidence, but we've said it before. It feels bad. No one that isn't desperate is buying out of the money options, weekly options with that much money. I've
got to take the Adam Newman story isn't over.
I hope not.
I think
fun.
He might invent a new company that does really well. And it was just misunderstood.
Him, Billy McFarland, Martin Shkreli, Travis
Elizabeth
Holmes, Travis Kalanick, and then the chairman of the board can be
Masayoshi-san.
Elon Musk. Okay, those ones. I'll admit, Open Door seems okay.
Yeah.
I was looking at their gross margins. They're bad, but they're be able to scale a lot of revenue. I'll marry them just because it seems good. Chamath has he has a good reputation. And then what's the other one? Playboy.
You have to bang Playboy.
Yeah, I mean, what am I saying here?
It's written there.
Yeah.
Yeah, I'd probably do all the same things. I mean, Chamath is a good investor. I think he overdoes it sometimes, but
he's a hype beast. It's okay.
But he's good at what he does. Okay. Anecdotal evidence. I really only have one.
So do I.
I started watching Billions.
Nice.
It's so good.
Yeah, you want to be Bobby Axelrod, right?
It's so good.
It is. Have you finished season 1?
Yeah, I'm getting into season 2.
I mean, end of season 1 when they showdown when Chuck and Axe are at it's intense.
I mean, is there anything Andrew Ross Sorkin can't do? That guy is so good.
Yeah, he's probably on CNBC. Him and David Faber are the only guys there.
No, what's the girl?
Oh, Becky Quick. Yeah, she's good.
She's solid. Yeah. Anyway, that's mine. That's not even.
That's good.
Nothing to take away there except Andrew Ross Sorkin's a beast.
Yeah, and if you're an investor or even like a lawyer, that show's a must watch.
Yeah, definitely.
Okay.
What did you have?
Yeah, I'll wrap things up. Got my Stitch fix and liked it a lot. The anecdotal evidence. This is real
anecdotal evidence.
So worked well. I liked what they had. I put some wrong sizes in, which is my fault. So I had to exchange some things, but it's coming back right away. I mean, I can see where they have a lot of upfront costs because you have to send things twice sometimes, so a lot of shipping costs. But I honestly loved all the clothes I got. This thing I'm wearing right now, it's nice.
Go to the YouTube, check it out.
Yeah, so if you want to see some anecdotal evidence, I'm right here. But
if you're long Stitch Fix and not watching this on YouTube,
yeah. But I liked it a lot, and I think every few months or maybe probably a little longer for my style, but.
How many things did you buy of the things you got?
Well, I would have bought everything except for these shoes. They're a little too fancy for me, so I'm going to get some casual shoes. But the only reason I sent stuff back was because it was like a large, and I need a medium. So I liked everything else. 4 out of the 5 things I liked.
Wow.
Yeah.
Long Stitch Fix. Okay. That's going to do it. Thank you guys for listening. Follow or watch this on YouTube if you're interested.
Check out Will Hershey at Roundhill.
Brady's been getting on those thumbnails. We've been getting some hate comments.
Yeah, I love the YouTube comments. Get in the trenches.
It's a battleground out there.
Yeah.
But yeah, thank you, Will Hershey, for coming on. Follow us on Twitter, or if you have a recommendation for a show or anything for us to talk about, just add us or email us, chitchatmoneypodcast@gmail.com. Thank you guys for listening. We are not financial advisors. Anything we say or discuss here on Chit Chat Money is not formal advice or recommendation. Thanks for listening. We'll see you next week.